income ratio is a little higher than we'd like to see. Those have been suspended or really tightened. So we are losing a lot of loan products. But for our general, I think, population, people that are in just the midstream, normal homes, not big high-end stuff, I think those are still safe, although the rules are tightening a little bit. But yes, we're losing a lot of loan programs.
What is happening as far as the upper end then? If the jumbo loans are being, you didn't say suspended, some of them aren't doing those loans, but could you elaborate a little bit more?
Well, if there's a jumbo loan in process, it depends on when, if the rate was locked, it depends on when those originated, when the sales took place or the refinances. A lot of lenders are still honoring them, but they're not allowing any new ones right now. So just because they consider jumbo loans, they're putting more money out, and investors are trying to hang on to their liquidity and not invested on one loan. So that's why the jumbo money has kind of been restricted and suspended. So not every single investor has done that yet, but most of them. Most of your Wells Fargos and most of our jumbo investors have suspended them.
So is there a workaround for that? Because there are homes on the market right now that are in the upper end.
Right. I think the workaround is going to be the amount of down payment people can put down. So to keep their loan balance lower, to keep it in what we call conforming balance. So if they're fortunate enough to have a big down payment, then that isn't going to be an issue. So it's not the value of the home, it's the amount of the loan that the investors are nervous about.
And what amount do they need to have that under?
Well, conforming is, I believe it's around 425,000. It might be a little bit higher than that. Different counties, it depends on the county that the home is in, are still considered conforming Fannie Mae, Freddie Mac loans. But anything over that amount falls into a jumbo category, and those are the ones that are being restricted and suspended.
Okay, great. Thank you for explaining that a little bit more. Now, you did mention this earlier, refinancing. You said that there's a lot more happening. Is now a good time to refinance?
It's actually an excellent time to refinance because the rates are so low, and who doesn't want lower payments? A lot of people are refinancing and taking advantage of the fact that their homes have appreciated in value, and so now they can refinance and get rid of their mortgage insurance and also take advantage of that lower rate. So it's a tremendous help for a lot of people. Unfortunately, in getting into the bad parts of what the COVID-19 is causing our industry and the general economy, people are losing their jobs and being laid off because businesses are closing. And so they're, although it's a great time to refinance, you have to have a job that's still stable and you can't have been laid off. And so that is affecting a lot of people and a lot of the refinances.
Well, that actually flows right into my next question. Is that making people afraid to even buy a home?
Well, the rise in unemployment and social distancing have, it's battered us all and it's dragged down our confidence. Overall, the purchase index is down by like 20%. So, and that's not just buying homes, it's buying any high ticket item, automobiles, anything that's the high ticket, but it's down 20%. So yeah, it's not so much people are afraid to buy, they're not able to buy right now because they are losing their jobs. And those who haven't lost their jobs are a little concerned about how long it's going to take for our economy to come back. So it's definitely slowed down.
Have you seen the number of buyers that have contacted you as far as wanting to get a loan prior to COVID-19 that didn't get a home or haven't been in a home yet? Have you seen those people decide to wait or hold off as far as purchasing to see what happens with the housing market?
I've seen a few, yes, because they're all hearing that prices are softening. So when you hear that, you think maybe I should wait to buy. My answer to that is that you might wait to buy, but when you, at the end of your wait period, if the interest rates have gone up, you've lost all ground. So it's always better to buy at a price that you can afford with these great interest rates. And then, because what goes up comes down and vice versa. So prices might soften, but they're going to go back up again. Everything does. So you have to be more concerned about what interest rate are you going to pay. So you might have, if you had waited, you might have saved a few thousand on a sales price, but you've lost a lot on interest rate and interest that you paid. So you have to analyze all aspects of that. That's my answer to people who think they should wait. But,
and have they taken you up on that as far as continuing to look to purchase?
Yes, they have. Not everybody, but in general they have. But we're dealing with so many things. They may see the reasoning behind all that, and then they lose their job. So, we're just seeing so many factors that are involved in this that it's hard to judge what their reasoning was for moving forward or backing off.
Got it. And actually, quite frankly, even on the properties that we have on the market, when we get an offer on them, one of the first things I ask is about the buyer's job. Because they may have it now, but are they going to have it 30 days from now when we need to close escrow?
Well, that's right. And so the big question is, can they still qualify? I mean, what this industry is doing now, and what Fannie Mae and Freddie Mac and FHA, everybody is asking us to do, the investors that we hope to sell these loans to, we used to verify their employment, make sure they were still working, generally about 10 days before we were due to close. It was just a verbal, hello, is Mr. So-and-so still employed? Now we have to do that 3 days before we close. So
oh, wow.
that's a huge difference. And that in itself slows down closings too, because we have to do those last minute verifications, especially for wage earners. Self-employed people, now we're asking them for their receipts to prove that they're still getting work. And that we're asking for those within 3 days of closing. So we have to prove, and that went from 120 days. We used to just verify that a business was still open within 4 months of closing. Now we have to do that in the last few days. We have to make sure that business is still working and see receipts that they're actually getting jobs and income. So
what a huge difference. I can understand why it takes longer to close escrow when you've got these basically checks right before you close.
Last minute, and then sadly sometimes we can't verify it, so we can't close the loan. And there's no way to know. I mean, one day you're working and the next day you're not. You don't know what your business might start out being considered an essential business, and then someone in government changes their mind and says, we don't believe you're essential enough to stay open for the safety of the public, so you're done. Or your customers just decide they stop their orders or their requests for services. So we have to wait to the last minute to make sure that that's still a viable business.
Understood. My gosh. So basically, if I have a loan in process and I lose my job or my hours are cut down, the loan doesn't go through?
That's true. Now, your hours might be cut down. So what we're going to do then is qualify you based on your new lower or lesser hours, your new income as it is today. So if you can still qualify with that, then you're okay. We're going to close the loan. We're really trying, the industry is doing everything they can to continue to keep our industry going, to continue to allow people to refinance. And, you know, it's a catch-22. If your hours are cut, you need a lower payment. And so if we can go ahead and provide that, we will, to a point. But we have to also go by what our investors are requesting of us. But so it doesn't mean you won't get the loan. It just means hopefully your hours weren't cut enough to where you can't qualify anymore. But if you lose your job, we cannot close that loan, because we don't want to start a foreclosure debacle in the industry. And that could happen if we continue to close these loans and not do these last minute checks.
Now, one of the things talking about foreclosures is I was a real estate agent because I've been an agent for 20 years. And so during the 2007, that time period, we definitely saw in 2008 a tightening of the loans. And so fewer buyers were actually able to qualify for a loan. Mm-hmm. Is that kind of what we're seeing now?
It is. It's, you know, caused by different reasons, of course, but yes, we are seeing that. We're seeing tightening. We're seeing riskier loans suspended. We're seeing requirements that people have reserves, which means a couple of months house payments left over in the bank to fall back on. You know, we're starting to implement those rules. So yes, and just qualifying in general, we're being very careful about debt to income ratio and extra assets. So yeah, it's tightening up. It is, definitely.
Got it. Well, I'm going to switch gears a little bit. Can you talk about a forbearance and what it is?
A forbearance is, and it's happening now. I'll give you Flagstar as an example. Because of COVID-19, we are offering people who do apply for it and call us and ask for help, who have lost their jobs. We are offering a 3 to 6 month forbearance, which means you can skip 3 to 6 months of house payments, mortgage payments. Because we're trying everything we can. We don't want to foreclose on your home. You know, that's the least that the world needs at this point, is people leaving their home, especially when we've been ordered to stay at home. So we are offering that. You do have to apply for it, and I'm certain, and even though I'm not on that end of it, I'm certain you have to prove that this is because the COVID-19 has affected your income. I'm sure that if you were behind on your mortgages prior to this pandemic, there wouldn't be a lot of sympathy regarding that. But if this is the reason, then we are offering that. You know, so I just would caution people to be careful about just accepting that immediately, thinking it's a gravy train, because it's not. We all have to pay the piper. So at the end of that 3 to 6 months, those payments are due. Now, we realize that you're not going to have 6 months of payments sitting in your pocket at the end of that term. So we do have workouts for you. We will set up a payment plan for you, increase your normal mortgage, and let you pay it back over time. And you know, so we can do that. You know, there's different plans. We have 2 or 3 plans. And then there's also, at the end of that term, if none of that's going to work, if you're still not back to work, we'll possibly look at modifying your loan. And that goes back to the old days from the 2008, from the, you know, to prevent foreclosures. will do loan modifications. But so I would caution people to not just accept that, realize that at the end of that term, the piper has to be paid, and it could still result in foreclosure if none of the workout plans are going to work for you. But we will do everything we can.
Part of what they owe instead of making the full payment? Is that something that's possible?
We would set up a payment plan, and forgiving some of that debt could be in the cards, but I haven't seen that roll out yet. It doesn't mean it won't. I know that our government is doing everything they can do. They're putting money in the economy. They're trying to support small businesses so that small businesses can keep their employees getting a paycheck. So the government's helping all of us, and that's just our part of this forbearance and these workout plans. So no, they don't have to pay it all back all at once. It could be set up over a payment plan, but you still have to have an income or that wouldn't work. So but we have 2 or 3 different plans.
Great. And you said Flagstar is one of them, and there's other banks that are doing the same thing?
Oh yeah, probably most of your major banks are doing it. I can't speak to the smaller mortgage companies or the smaller companies. I know we've all been ordered not to, file for foreclosure and do everything we can. I can only really speak for Flagstar. I know for a fact that we're offering the 3 to 6 month forbearance plan. And I'm sure other major banks are doing the same.
Great. So this next question is one that I get often, and I'd like to know what your opinion is. How long is all this going to take for the economy to recover?
Well, that's a good question, and it's a hard one to answer, obviously. But I can tell you that, and I mentioned this before, the feds are working really hard to put money in the economy, to keep the small businesses going. They're doing what they can. It's never enough money, but I think they continue to keep adding to that. And by doing that, that will ensure an eventual recovery. But the date, now we're being told that maybe by the end of May, the stay-at-home orders will be lifted. We don't really know if that's going to happen or not, but even if it does, we're not going to bounce back in a day or a week. It's going to take a couple of years. We had, if I remember correctly, as of this morning, there were 22 million jobless claims, 22 million people out of work. And when 22 million people are out of work, it halts the economy. And when those people go back to work, and not all of them are going to be able to go back to work, the businesses that they worked for, some of those businesses will never open again because they've been devastated and they just couldn't do it. So those temporary job losses are now going to become permanent job losses. So that is going to take, in my opinion, at least a couple of years. I've been reading other people's opinions, and they all seem to think that, it's going to be a couple of years before the economy comes back. And I don't know what it'll look like after those 2 years. It's not going to be the same as we knew it before the pandemic. It will definitely be different. I think we're going to be restructuring our economy, and I think that possibly even restructuring our financial system. The 2008 housing crisis was caused, had different reasons. It's caused by a lot of fraud, a lot of cheating, a lot of collusion, a lot of greediness. This problem certainly is different. But every time something bad happens, we learn from it and we learn how to best prevent it from happening again. But the world's not used to a pandemic causing an economic crisis. So we don't know how to handle it, but we're learning. And but it's going to take a while. And you know, this is an economic breakdown. It's not a recession. So, and it's new. So we're going to learn the hard way and learn by, you know, trial and error, I'm sure. But it will be a couple of years.
Yeah.
Well, at least.
Thank you, Debbie. I have one last question before I open it up to the audience. Reverse mortgages. Does this affect reverse mortgages in any way? Those that have them and those that are thinking of getting them?
Those that have them, absolutely, there will be no effect whatsoever. The great thing about a reverse mortgage is that no matter what happens to the economy, they're not going to change the terms of your reverse mortgage. Those who took the option of a line of credit, that line of credit is never going to be closed. It is still your money to access. From what I can tell, in the future, I have not seen any changes to any reverse mortgage rules. It's a different animal. You know, it's still a mortgage, but yet it's completely different animal type of mortgage with different rules, and so this hasn't really affected it. The only thing that might be affected is if housing prices soften, then that means your equity position is a little less than it might have been the day before. And so therefore the amount of money that you can access is going to be a little less. That's the only thing I can see. But the rules haven't changed and the guidelines haven't changed. So I think that's in good shape.
Terrific. That's great. Is there anything you'd like to add before I see if the audience has any questions?
No, I don't think so. I'm anxious to see what those questions might be and hope I can answer them.
Okay, terrific.
So we have a couple of questions in the Q&A box. Danielle would ask the question about how about reverse mortgages, any changes? So I think we've already covered that.
Mm-hmm.
And the next question from Mike, it seems many people think that forbearance means forgiveness. Comment, please.
If you remember what I had said about the caution that I gave people about jumping in and taking advantage of the forbearance, that caution that you should be thinking about is that it is not forgiveness. It is just deferment. In other words, they're going to defer your payments, allow you to skip 3 to 6 months without affecting your credit report, without affecting anything. But at the end of that term, that money is still due. Now, they might put it on the end of the loan. They might let you make payments over time, or they might end up modifying your loan in some form or fashion. But it's not, they're not forgiving that money. They're just deferring it. I hope that answers.
Do you have any other questions? Thank you, Debbie.
I just asked Debbie, will that happen automatically? Can I just stop making payments and the bank will take care of it later, or do I need to speak with you?
No, absolutely not. No, you must contact your lender. They have an application form that they're going to ask you to complete, and they will approve it or not approve it. You know, they are going to ask, they're going to look to see that this was caused by COVID-19, that you lost your job or your income, substantial income, because of this pandemic. But there is an application. It is not automatic. You must contact them and ask to apply for it.
So if the time comes and you do not contact your bank and then you end up being late on your payment, can you contact them at that point after you're late and work on getting a forbearance, or it's really important you do this before that happens?
Well, obviously, you don't want to put things off, because one thing you want to protect is your credit rating. If you've applied for the forbearance, you're protecting your credit too. If you just let it go and let it slide and hope for the best and then contact them after you're already late, you know, there's no guarantee that they can protect, because you didn't apply for the forbearance. So just do it smart, and you know ahead of time. You know ahead of time if you're going to have the money to make your mortgage. You know. So contact them as soon as you know that you can't make that payment.
Good advice.
So we have another question from Ken. Have investors in the secondary market slowed bank lending?
Well, yes, they have slowed it in the forms that I spoke about earlier, by suspending some of the loan types, suspending constructions, suspending jumbo loans, tightening up on guidelines, requiring monthly reserves on loans that weren't required prior to that. So they have slowed it down, yes.
Thank you, Debbie. And then we just want to do a quick test with the audience, because people can actually speak and be heard if they have a question. We won't do that to anyone just yet, but if you're on your phone, you can raise your hand by pressing *9, and again, we won't call on you. We just want to see if people are able to do that and if it's working. And then if you're on a smart device, if you just touch your screen somewhere, then you should have a little pop-up that comes up and you should see raise hand. So I'm just wondering if everyone could raise their hand either via the phone pressing *9 or on their device, just as a little test to see how many people successfully raise their hand there. I see 1, 2. I see 2 people who work out how to raise their hand. 3, keep going, this is great. And at the end, I'll just lower everyone's hand. So we have 4 people out of about 25. So again, if you're on a smart device, there I see a few more, just tap on the screen somewhere and it should pop up and you should see a little icon that says raise hand. Again, if you're on your phone, you press *9. And to do the opposite, if you change your mind, you can just press the raise hand button again and that'll lower your hand, or *9 on a phone. So I'm just going to lower everyone's hand. So everyone's hand is now lowered. So if you do have a question, you can raise your hand and then we'll get to you. We'll unmute you and then we can have you, everyone will hear what your question is. You don't need to say who you are, and then we'll answer it. Or for those who prefer not to speak, you can just type into that Q&A box. Again, when you tap the screen, it'll pop up a little pop-up that has Q&A. If you click on that, then you can type in your question. Hopefully that was clear. So we have another question, Debbie. Can older buyers still get VA loans, Veteran Affairs loans?
Absolutely. Age never comes into play, except if you're younger than 18. Age has nothing to do with your ability to get a loan. You can be 99 years old and still get a 30-year loan, whether it's VA or any other kind.
Excellent.
Yeah,
Thank
that's
you.
great.
So that's the last of our questions. So unless anyone's busy typing in a question or would like to raise their hand, we'd like to, I'll let you do the closing.
Yeah, thank you so much, everybody, for joining us today. And if you do have further questions, you can definitely reach out to Debbie. We have her phone number up on the page here. And you can give Brett or I a call, and we're happy to help you. So thank you, Debbie. You're a wealth of information, as always. I really appreciate your time.
Just before
Comes with age. You're welcome.
And the question from Doug is, what is the typical down payment percentage? And I'm not sure what loan Doug is referring to, but is there a difference in terms of the down payment percentage, whether it's a VA loan, a regular loan, a reverse mortgage? Can you just maybe touch on those 3?
Well, obviously VA loan, USDA loan, those loans require no down payment to qualified veterans. USDA depends on the location of the property. FHA is 3.5% down. That has not changed. And with conventional, it depends. We still have the 3% down conventionals, which would obviously require mortgage insurance. So it really just depends on credit score and a lot of other factors as to what you can get by with or what percentage, but that so far has not changed.
Great.
And that's all the questions we have. So
That's all the questions. So thank you so much. Everybody have a great day.
Bye.
Thanks for your time. Bye.